What is private equity? Hello, everybody, and welcome to my YouTube channel. I'm your learning partner, Sushila Hariharan, and we're starting a new series on private equity. I've already uploaded a lot of videos on hedge fund accounting, trade life cycle, investment banking operations, as well as OTC derivatives. And if you're interested in a career in these domains, I urge you to subscribe to my YouTube channel. Let's understand over here what is private equity. Private equity refers to the structure of a firm that invests in unlisted stock of different companies. So then you might ask me, how is private equity fund different from a hedge fund? Okay, so while private equity fund is similar to the hedge fund in a structural way, in the sense that we have a general partner, the general partner collects capital from limited partners, and the capital is then pooled together, and this capital is then invested. The similarity ends there. Private equity funds collect capital from accredited investors and invests this capital into different unlisted stocks of companies which look promising in their business growth and revenues and incomes. So how is private equity structured? How does it work? Let's understand this. We can understand that the private equity fund manager is not a person who's going to be trading every day like a hedge fund manager, right? He and his research team need to find out investment opportunities. So when they have to find out investment opportunities, they will search around the different markets, different business opportunities, and then they will come up with a list of companies that look promising in their business growth and revenues. But the private equity fund has therefore to structure the capital contribution from its limited partners in a different way compared to a hedge fund. So what a private equity fund does is it collects capital commitments from the limited partners at the time of forming the partnership itself. This is clearly mentioned in the limited partnership agreement. So if there are 5 or 6 limited partners, each of them give a commitment, all right, to contribute to the private equity fund on specific dates, on specific periods of time. The fund manager thus knows that they will get the capital at different points of time. So the capital into a private equity fund comes from the same set of investors, or sometimes even different set of investors, but at different points of time. All right, this is a very important understanding. Once the business has been identified, once the company has been identified by the fund manager as to where they're likely to invest, they will go back to the limited partner and get what is called as a capital drawdown. Okay, so we have two very interesting terms over here. One is capital commitment and the second one is capital drawdown. A capital commitment is given by the limited partners to the private equity fund that they will be contributing the capital. But the capital inflow or the capital infusion from the limited partners into the private equity fund doesn't happen at a point of time. It happens over multiple points of time. And that's a very critical assessment of how the business operates in private equities. Okay? The private equity fund, therefore, collects the capital from the limited partners only if it has identified the right opportunities. So we have capital commitment, all right, and that leads to a capital drawdown. A capital commitment is a commitment given by the limited partners to the general partner, to the private equity fund. And when the opportunity to invest has arisen, then the private equity fund sends out capital drawdown letters to all the limited partners who then make the capital contribution accordingly. So we understand that the investment into the private equity fund itself happens in a staggered way. It doesn't happen at a single point of time. So this explains how capital has been contributed by the limited partners into the private equity fund. The private equity fund then invests in unlisted stocks. These are also called as pre-IPO stocks sometimes. Sometimes it could be even at multiple stages before the IPO. It need not always be a pre-IPO, but just suffice to know at this point of time that the private equity funds make investments into companies in the unlisted space. The company stock is not yet listed on the stock exchange. The private equity fund then stays invested in the company, in fact, literally becoming like financial partners to the company to help the company grow. So the difference between private equity funds and hedge funds is huge. The hedge fund is more of a trading mentality. Okay, the fund manager gets up in the morning, sees various opportunities to trade in equities, commodities, currencies, bonds, money market trades, etc., and then decides to trade. But that's not the temperament of a private equity fund manager. Private equity fund manager is looking at investing over a long period of time and therefore must be very sure that because it's taking a controlling stake, perhaps in the investee company, it will stay invested for at least 5 to 7 years. The private equity fund, therefore, is largely focused on investing in the unlisted space. Just like how we have private equity funds, we also have private credit funds, which in the last 26 months has shown a burgeoning growth in markets across the world where companies, promoters do not want to dilute their ownership by giving away stake to the hedge fund managers, to the private equity managers. They would rather stay invested in these companies and give them the credit or borrow from them by way of mezzanine financing or subordinated debt. In the next video, we're going to take a look at the investing style of private equity firms. Thank you so much for watching in.